Welcome to the deep dive. Today, we are taking you inside a very specific room in Delhi on November 20th, 2025. And this wasn't a huge, sprawling political negotiation, but for nearly a million people, the outcome of this meeting could really define the rest of their lives. I'm Priyanka Chakraborty, and my co host is Anil Agrawal.
That's right. We're focusing on a meeting between essentially the representatives of India's banking retirees and the highest financial administrative body in the government, the Department of Financial Services.
Okay, so who are the key players here?
On one side, you have the coordination of bank pensioners and retirees organizations. We'll just call them CBPRO to keep it simple, and their affiliate, IBPAC. And they met directly with the Secretary of the Department of Financial Services, Shri Nagaraju Madderala, IAS.
So the Confederation of Bank Retirees Union went straight to the top. The mission of this meeting, it wasn't subtle, was it?
Not at all. CBPRO showed up with a detailed multi-point memorandum. It was all about addressing, and I'm quoting here, various issues affecting the interest of bank pensioners and the retirees.
But there was one headline issue there, right? The big one.
The big one, the one that's been driving this whole thing for decades, which is the pension updation.
And just to give you a sense of the scale here, the documents we've seen give us this comprehensive look into the grievances of over 8 lakh people.
800,000 bank pensioners. And it's important to understand, this isn't about fixing some future problem. This is about resolving what retirees see as a denial of fundamental, legally owed, constitutional rights that they've been fighting for since the early 1990s.
Okay, let's unpack this then. The core fight here feels like a mix of constitutional law, some pretty dense fiscal, actuarial calculus, and just a basic struggle for dignity in retirement for the elders of India's banking. We have to start with that central demand. Pension updation. When they say updation, what exactly are they asking for?
It's a demand that's been on the table since the 1992 wage revision.
1992, wow.
It's a staggering timeline. And CBPRO argues that what bank retirees are fighting for isn't discretionary bonus. They say it's a legal, even constitutional entitlement, although not in those exact words. And they base this on an amendment made to something called Pension Regulation 35.1.
Okay, and when was that amendment first introduced?
Way back in 1995.
So what did Regulation 35.1 actually say that gives them this claim?
It mandated the periodic updation of pensions for bank retirees, a long-standing demand that is still under discussion and advocacy, with no final implemented amendment as of November 2025.
And their critical legal argument now is?
It's that there is no court order, none, that stops the banks, the Indian Banks Association, or the government from actually using the formula laid out in that regulation.
That is a really crucial distinction, isn't it? It suggests the inaction is regulatory or administrative, not because their hands are tied legally.
Exactly. The law is there, but the action hasn't been taken.
And looking at the supplementary document they submitted, they're very specific about how the calculation should work.
Oh, absolutely. The demand is that, I quote, basic pension and additional pension, wherever applicable, shall be updated as per the formula given in Appendix 1. It's basically a plea to finally turn on the machine that was legally built decades ago.
I'd like to clarify something because this could get confusing in these long-running labor disputes. Doesn't this overlap with things like cost of living adjustments like dearness relief?
It does. And that's why CBPRO is so explicit about it. Their fight is for pension updation under Regulation 35.1. That's about revaluing the basic pension amount periodically over time. It is not just a request for better dearness relief, which is covered separately.
And why is that distinction so important for them?
Well, think about it. If your basic pension amount is stuck in the past, any cost of living adjustment you get is calculated on a fundamentally outdated low number. They feel they're facing what their own document calls dual exclusions.
What's that in plain English?
They're being hit twice. First, the main pension isn't updated. And second, the cost of living relief they do get is way less effective because it's based on that old smaller number. It just compounds their financial disenfranchisement.
Okay, here's where it gets, for me, really compelling: the discrimination argument. You mentioned 800,000 people who feel like they're being treated as second class citizens. Who are they comparing themselves to?
They point to two main groups who are getting the very thing they're asking for. First, central government pensioners. Their pensions get updated periodically, almost automatically, whenever the Central Pay Commission recommendations are implemented.
And the second?
The second comparison is even more direct. It's their colleagues in related institutions, the RBI and NABARD pensioners.
The Reserve Bank of India and NABARD.
Right. And the core grievance is that the government itself approved an updation method for RBI and NABARD pensioners that is fundamentally different and much better than what's being applied to State Bank and the other public sector banks.
So you have people working in the same industry sector, banking, under the same government's oversight, but living under two completely separate and unequal pension systems.
Precisely. And that's why CBPRO explicitly says this disparity violates the principles of equality under Article 14 of the Constitution. So this isn't just about a regulatory slip-up anymore. They see it as a constitutional issue.
That elevates the whole debate. But we have to talk about the elephant in the room: money. If they have this statutory and constitutional right, why hasn't it happened? The banks must be saying they can't afford it.
That's historically been the counter-argument, yes. It centers on actuarial liability. They fall back on Pension Regulation 11, which says they have to set aside funds for any potential losses. They express a worry that this updation could destabilize the pension fund long-term.
But using the fund for pensions shouldn't be destabilizing, right? I mean, if the fund is healthy, does the documentation say anything about the actual size of this fund?
It does. And this is where the CBPRO argument gets really powerful. They lean on a Supreme Court ruling, DS Nakara, which established that a pension isn't a gift or a bounty. It's a deferred wage, money, or property you've already earned.
Okay, so let's get into the specific numbers from the documents. What are we talking about here? Fund size versus the actual cost.
The total pension fund for all public sector banks is colossal. As of March 2024, it was 427 lakh crores. CBPRO notes it's probably closer to 5 lakh crores by now.
5 lakh crores? Okay. And the annual cost to actually do this updation?
It's estimated to be around 3,088 crores. And that number comes from calculation sheets submitted to the government and the banks themselves.
Wait, hold on. 3,088 crores a year against a fund of 5 lakh crores. That completely changes the debate. It shifts it from you can't afford it to something more like we don't want to allocate funds to it. I mean, that fund could cover the cost for 100 years or more.
It certainly frames it as a question of will and priority, not solvency or liquidity. The pensioners are basically saying the money is already there in their fund. It just needs to be released as promised.
Let's shift gears a bit from that huge, decades-long issue to something more recent, something that's affecting people who are retiring right now, the special allowance. This feels a bit like a financial loophole.
It's very technical, but it's a critical grievance. It comes out of the 10th bipartite settlement, which kicked in on November 1st, 2012. The banks introduced this thing called a special allowance, or SA. It's currently about 30.5% to 31.5% of salary.
Okay, and what happened when they introduced it?
To make room for it, they reduced the basic pay by 7.5%. But here's the damaging loophole. Your basic pay counts toward your pension calculation. The special allowance does not. It's explicitly excluded.
So you take a slice out of the part of the salary that counts for retirement and replace it with a bigger slice from a part that doesn't count. It's an instant loss on your final pension, even if your paycheck looks bigger today.
Precisely. The pensioners suffer a direct calculated loss. And they have legal ground here too. They point to a 2019 High Court case, Vivekananda Vidya Mandir. The judge in that case ruled that these kinds of allowances should be attached to the basic pay for pension calculations.
That's a strong sign this structure is on shaky legal ground. Okay, let's get even more technical, which usually means even more damaging for the retiree. DA neutralization and the consumer price index shift.
Right. This is a true deep dive. The problem started when they merged 8,088 points of dearness allowance, 12th bipartite settlement BPS, the DA, and this happened at the exact same time as a major regulatory shift. The index they used to measure inflation, the CPI, changed its base year from 1996 to 2016.
Why does changing the base year of an index hurt the pensioners?
Think of it like this. Your pension contract says your cost of living raises are based on, say, a meter stick. Then halfway through your retirement, they switch to a slightly shorter yardstick without adjusting the formula properly. When they merged those DA points and applied the new 2016 base, it created what they call anomalous DA formulae. It was especially unfair for those who retired just before the change.
And who got hit the hardest by this?
Well, pensioners who retired on or after November 1st, 2022 face these confusing new formulas. But the biggest disparity really affects the pre-November 2022 retirees, especially those who retired even earlier, before 2002. They're just caught in this permanent misalignment. So, CBPRO's demand is for 100% DA neutralization to fix this and give everyone true parity.
It just shows how complex it is trying to keep a financial promise across decades of changing economics. Okay, let's move from these individual money issues to the broader systemic changes they're asking for, starting with a very specific one for SBI pensioners.
Yes, a very targeted request in the memo. SBI pensioners are getting their pension at 40% of their basic pay. CBPRO is asking for that to be raised to 50%. And they also asked for one more chance, one more option for certain eligible left-outs to join the pension scheme, people who might have missed earlier deadlines, including some at the board level.
So that's about fixing a legacy issue at one specific major bank.
Yes.
But the final demand seems the most strategic. It touches on the actual power structure of these talks, the request for formal consultation status. Why is that so important?
It's the linchpin for their future. Right now, even though they represent 800,000 people, the bank pensioners organizations aren't officially recognized as representatives at the IBA negotiating table.
So when retiree issues are discussed, who is in the room?
The leaders of the United Forum of Bank Unions, or UFPU.
But they primarily represent active employees, not retirees. So the people negotiating for the pensioners aren't actually accountable to them.
Exactly. And interests can diverge. An active union might prioritize a current salary hike over protecting future pensions. CBPRO says the whole system is defective. They want a formal consultative status at the top level, so their voice is heard directly, not filtered through someone else.
That kind of structural change could completely redefine things for retirees.
Right.
If we just step back and look at everything from the constitutional claim to the fight for a seat at the table, what's the big picture here?
I think the documents show a fight that is fundamentally about the social contract between retirees and the government of India. The battle for pension updation is a complex mix of constitutional equality, actuarial math on a huge solvent fund, and labor rights that go back to 1992. You have elders of banking saying their patience has run out and they want constitutional justice.
Right? They're arguing that their demands aren't just a moral appeal, they're backed by, and this is another quote, statute, regulations, court verdicts, and established precedents, facts, and norms. They've laid out the entire legal and financial case.
And this whole situation is just a powerful example of systemic regulatory lag in a vital sector. When you look at these grievances stretching from 1992 through 2003, 2022, all leading to this 2025 meeting, it raises a really important question for you, the listener, and for policymakers.
Which is, how far back should a social contract like a pension be legally required to honor promises made decades ago, especially when economic measures keep changing? And maybe more critically, what kind of system could we put in place to ensure that these essential livelihood issues for senior retirees aren't debated, deferred, and litigated for 30 plus years?
That is the question hanging over the heads of the DFS Secretary and 8 lakh pensioners today.
Thank you for joining us for this important dive.
Please like, share, comment, and subscribe. Subscription costs nothing. Until next time.